China's economy just posted its weakest quarterly growth number in over 3 years. In the second quarter of 2026, GDP expanded 4.3% year on year, down sharply from 5% in the first quarter and below the 4.5% floor Beijing itself had set as the low end of its annual target. For context, that target range of 4.5 to 5% is the lowest Beijing has ever set since it began publishing growth goals back in 1991. When the government lowers its own bar and still struggles to clear it, that tells you something about the state of the underlying economy. The headline number hides a deeper split. On one side, exports are booming. Shipments rose 17.6% in the first half of the year, and in June alone, they jumped 27%, driven by artificial intelligence hardware and electric vehicles. Chinese factories are producing more than ever, and much of the world is still buying. On the other side, the domestic economy is stalling. Retail sales crept up just 1% in June. Fixed asset investment collapsed, with real estate investment down 18% in the first half of the year alone. China is running two economies at two different speeds, an export machine racing ahead while its own consumers stay on the sidelines. The clearest symptom of that imbalance is the property market, and it has now been unraveling for 6 straight years. Real estate and related construction once accounted for close to a third of China's total economic demand when you count steel, cement, home appliances, and local government land sales that depended on it. New home prices have fallen for roughly 20 consecutive months. Property investment nationwide has collapsed somewhere between 50 and 80% from its peak, depending on which region you look at. This did not happen overnight. Beijing's 3 red lines policy in 2020 was designed to force over-leveraged developers to deleverage. Instead, it triggered a liquidity crunch that toppled Evergrande, a company that owed more than $300 billion, and the collapse cascaded through the rest of the sector. Construction halted on millions of pre-sold apartments. Homeowners who had paid in full for units that were never finished began organizing protests in cities across the country, a rare sight in a system that tightly manages public dissent. Because property was never just a housing market, it was the load-bearing wall of local government finance, and its slow-motion collapse has pulled local government debt down with it. Estimates put explicit local government debt at around $13 trillion, and that figure does not include the far larger and harder-to-measure hidden debt sitting in local government financing vehicles. In 2025, interest payments alone on local public budgets grew nearly 7% year-on-year, a rate that outpaced the official GDP growth number for the same period. Local governments used to fund themselves by selling land to developers. With developers retreating and land sales drying up, that revenue stream has narrowed just as debt servicing costs climb, leaving many provinces dependent on Beijing for bailouts and debt swaps. Layered on top of the property and debt story is something more unusual for a major economy: deflation. China has now experienced roughly 10 consecutive quarters of deflationary pressure, the longest such stretch since it transitioned to a market economy in the late 1970s. Consumer price growth is stuck near 1.2% against an official 2% target, and in some measures, prices have outright fallen. Persistent deflation is dangerous precisely because of what it does to behavior. When people expect prices to keep falling, they delay big purchases, waiting for a better deal tomorrow. That is the same trap that locked Japan into decades of stagnation, and Chinese economists are now openly using the comparison. Beijing has rolled out trade-in subsidies for appliances and electric vehicles, consumer vouchers, and interest rate cuts to try to break the cycle. But analysts at Fitch and the World Economic Forum have described these measures as too small to shift a savings-heavy economy into a spending-heavy one without deeper pension and welfare reform. Then there is the demographic backdrop, which makes every other problem harder to solve. Youth unemployment for workers aged 16 to 24, excluding students, has been running between 16 and 17% through 2026. It briefly crossed 21% back in 2023, a number so alarming that the government simply stopped publishing the data for several months before resuming with a revised methodology. A generation of university graduates is now entering a labor market where the very sectors that used to absorb them, property, private education, and technology, have all contracted at the same time. Meanwhile, the birth rate has kept falling, hitting just 5.6 births per 1,000 people in 2025, the lowest ever recorded in the country. An aging, shrinking workforce is, by itself, a deflationary force, since older populations tend to save more and spend less, and China is aging faster than almost any large economy in modern history. All of this is putting pressure back on Beijing to act. Premier Li Qiang has already called for stronger counter-cyclical measures, and attention has turned to a late July Politburo meeting where economists expect policymakers to weigh in. But most analysts expect only modest fiscal stimulus rather than a decisive shift, unless the numbers deteriorate further. Part of the hesitation is structural. Local officials have long been rewarded for hitting growth targets rather than for the quality of that growth, which is part of why China ended up with so many oversized infrastructure and housing projects in the first place, many of them now sitting half-finished or barely used. Reversing that incentive system is a much bigger undertaking than cutting an interest rate or issuing another round of consumer vouchers. The slowdown also matters well beyond China's own borders. As the world's second largest economy and its largest buyer of industrial commodities, a weaker China means softer demand for the raw materials that power economies from Australia to Brazil. At the same time, Chinese factories unable to sell enough at home are pushing more of their output onto global markets at aggressive prices, a dynamic already prompting new tariffs and trade barriers from the United States, the European Union, and emerging markets like India that compete directly with Chinese manufacturing in steel, chemicals, and electronics. The same overcapacity that is dragging down Chinese factory profits at home is now exporting deflation to the rest of the world. The International Monetary Fund's own projections capture the trajectory well. It expects China's growth to land around 4.6% for 2026, then slow further to 4.1% in 2027, driven by a declining labor force, falling returns on investment, and slowing productivity growth. None of this points to a sudden collapse. China is not falling off a cliff. What it faces instead is something slower and arguably harder to fix. An economy that spent 3 decades built around debt-financed construction and an ever-expanding workforce now trying to function without either of those engines, while leaning almost entirely on exports to keep the growth numbers respectable. That reliance carries its own risk because it puts China's growth rate increasingly at the mercy of foreign trade policy, tariffs, and demand cycles it does not control. The property crash, the local debt overhang, deflation, and the demographic decline are not 4 separate problems. They are 4 symptoms of the same underlying shift, a growth model that worked brilliantly for 30 years and has now run out of road.